Asset liability management is the most useful analytical tools which help to reduce risk exposure in the banking system. It provides banking system with defensive weapons to handle business cycle and seasonal pressures. It also helps to shape portfolios of assets and liabilities. There are three asset liability management strategies. The first is asset management strategy. This strategy views the amount of deposits and the borrowed funds were largely determined by its customer. The banker can only control the incoming funds by deciding who was to receive the quantity of loans. The second strategy is liability management strategy. For this strategy, the bankers can control over the price and interest rate on their deposits and borrowings to achieve volume, mix, and the third is funds management strategy. There are several objectives. Management should exercise as much control as possible over volume, mix, and return across both assets and liabilities. Control over assets must be coordinated with liabilities. Revenue and cost must arise from interest rate risk is the challenge for asset liability management. This is because the change of market interest rate will impact both the balance sheet and the statement of income. In order to limit the loss in net income or equity, there is a popular interest rate hedging strategy, which called interest-sensitive gap management. This technique requires management to perform an analysis of the maturities and repricing opportunities associated with interest-bearing assets and deposits. To hedge the interest rate risk, the management should match the dollar amount of repriceable assets or interest-sensitive assets to dollar amount of repriceable liability. Interest-sensitive gap is the difference between interest-sensitive assets and interest-sensitive liabilities. There are three possible cases will happen. First, when interest-sensitive assets more than interest-sensitive liabilities is called asset-sensitive gap or positive gap. In this case, the increase in interest rate will increase net interest income. The decrease in interest rate will decrease net interest income. The possible management response for this risk is do nothing or increase ISL or decrease ISA. The second possible case is when interest-sensitive assets less than interest-sensitive liabilities. It's called liability-sensitive gap or negative gap. In this case, the increase in interest rate will decrease net interest income. The decrease in interest rate will increase net interest income. The possible management response for this risk is do nothing or decrease ISL or increase ISA. The third possible case is when interest-sensitive assets equal to interest-sensitive liabilities or is called zero gap. In this case, the increase and decrease in interest rate will have no effect to the net interest income. The first method to measure interest-sensitive gap is dollar gap, which is interest-sensitive assets in dollar amount minus interest-sensitive liabilities in dollar amount. If the dollar gap is positive, banks is asset sensitive and vice versa. The second method is relative interest-sensitive gap, which is dollar gap divided by bank size or total assets. If relative interest-sensitive gap is greater than zero, bank is asset sensitive. The third method is interest sensitivity ratio, by using interest-sensitive asset divided by interest-sensitive liabilities. If interest sensitivity ratio is greater than 1, bank is asset sensitive. There are also three ways to measure interest rate risk exposure. The first way is cumulative gap. This measures the total difference in dollars between those assets and liabilities that can be repriced over a designated period of time. The second way is aggressive gap management. In this way, it depends on the degree of banks' confidence in their own interest rate forecast. For example, if management believes interest rates are going to fall, they will allow interest-sensitive liabilities to prime above interest-sensitive assets. The third way is weighted interest-sensitive gap. This approach takes into account the tendency of interest rates to vary in speed and magnitude. Under this approach, all interest-sensitive assets and liabilities are given weight based on their speed relative to some market interest.
Interest-sensitive gap management. There is no general optimal value for a bank's gap in all environments. The best gap for a bank can be determined only by evaluating a bank's overall risk and return profile and objectives. The further the bank's gap from zero, the greater the bank's risk. There are four problems with interest-sensitive gap management. The first one is interest paid on liabilities tend to move faster than interest rates earned on assets. The second one is interest rate attached to bank assets and liabilities do not match at the same speed as market interest rates. The third one, point at which some assets and liabilities are repriced, is not easy to identify. The fourth one is interest-sensitive gap does not consider the impact of changing interest rates in equity position. Duration is a value and time-weighted measure of maturity that considers the timing of all cash inflow from earning assets and all cash outflows associated with liabilities. Average maturity of promised stream of future cash payment, average time needed to recover the funds committed to an investment. The first concept of duration is how to calculate duration. A commercial bank grants a loan to one of its customers for a term of 5 years, an annual interest payment of 10%. The value of the loan is 1,000 ringgit, which is also its current market value price. Because the loan's current yield to maturity is 10%. This is how to calculate it, and the loan's duration will be 4.17 years. The second concept of duration is how to calculate change in net worth if interest rate rises. For example, suppose a commercial bank has an average duration in its asset of 3 years, an average liability duration of 2 years, total liability of 100 million ringgit, and total asset of 120 million ringgit. Interest rate was originally 10%, but suddenly they rise to 12%. And this is how to find and how to calculate, and the change in the value of net worth will be 2.91 million ringgit. The third concept is how to calculate the ringgit weighted asset portfolio duration. There are 5 different assets held with different market value and asset duration. And this is how to calculate. Use the summation for the duration of each asset multiplied with the market value of each asset and then divide by the total market value of all assets. The ringgit weighted asset portfolio duration for that time is 3.05 years. The fourth concept is how to calculate ringgit weighted liability portfolio duration. And this is how to calculate it. It's just the same as the example we've just seen. Use the summation for the duration of each liability, multiply with the market value of each liability, and then divide by the total market value of all liabilities. The ringgit weighted liability portfolio duration for the time is 2.72 years. And the last one is how to calculate leverage adjusted duration gap. The formula of how to calculate it: by substitute the figure computed for dollar-weighted asset duration and dollar-weighted liability, multiply with the total liability over total asset. The leverage adjusted duration gap for that period is 1.80 years.